It's time for Watts on Wealth Radio with Barry Watts and your host, Ralph Hipp.
You've spent your whole career saving for retirement. How do you make sure you've done enough and making sure you're not spending down what you've kept? Well, today on the show, we're going to share with you some simple ways to help you maximize your retirement income. That is the starting line for today's Watts on Wealth Radio show, along with Barry Watts at the Wealth Care Corporation of Springfield. I'm your host, Ralph Hipp, bringing Barry into the conversation. Hey, Barry, and any sage Watts wisdom to get us started today?
Well, I don't know about sage Watts wisdom, but we are going to talk today about how to have more income in retirement. And I suppose that would be a wise thing to talk about. And I do have 31 years of experience in helping people to achieve that. And so I'm kind of excited about that because increasing your income annually as the years go along every year for the rest of your life, well, that's a pretty rich reward for listening to an hour's worth of radio.
All righty. And Barry, projections from what they call the Employee Benefit Research Institute, that's an interesting name. It shows that 40% of our households where the head of the household is between 35 and 64 years old are projected to run short of money in retirement. Should those of us be in the pre-retirement category about we're going to run out of gas, we're going to run out of money, we're going to go to E on empty?
Well, Ralph, I think you should be very concerned about that. And honestly, I think that 40% number is kind of a conservative estimate because what you need to understand is that what gets you to retirement won't get you through retirement. And a lot of people don't understand that. They think the process of saving for retirement and then being retired and spending in retirement are the same. And it's simply not true. The way in which you accumulate money and then how you decumulate, well, they're very different strategies. So a retirement accumulation planner, for example, will probably tell you when the market fluctuates and goes down in value and your investments go down to just wait out the losses and it'll come back. But no, that's not necessarily true. I'm not saying it won't come back, not even addressing that. But what I am saying is withdrawals at the same time that the market is taking money out of your account, causing your account to go downward, and you're withdrawing to make it go downward even faster. Well, that spells disaster. And it can cause people to run out of money. And here's what you don't want, Ralph. You don't want to discover that you're running short because that's like being going across the middle of the desert and running out of water. It's like flying across the ocean. I'm going to do that here in a few weeks. And halfway across the ocean, learning you're out of jet fuel. You want to know when you retire that you've got enough to get you there. And that requires retirement planning math, and that's more sophisticated than what most of us learned in high school and in college. Because if you discover that you're running low at age 75 and you're going to run out eventually, well, it's really too late to fix it. You don't want to go back to work at that point. But if you'll carefully examine your situation right now, you can make adjustments now that don't necessarily require you to go back to work, that will extend your money and your income all the way, hopefully, to age 100. And I've actually got a story about that, Ralph, from our practice. We've got a client that we're working with right now, lives in Johnson City, Tennessee. That's over in eastern Tennessee. I didn't even know that was a thing, but there's a country music song about Johnson City, Tennessee, I think, if I recall. I can't think of the name of the singer. He used to be Hootie and the Blowfish. So whoever he is today, I think it's his song that sings about Johnson City, Tennessee. But anyway, here's the story. This particular client, he's in his early 60s, and we sat down and did a retirement income plan for him based on his plan, what he was planning to do. And he is going to run out of money at age 84. So he doesn't have enough money to get him to the last years of retirement. And so what we were able to do for him is we showed him how he could make some changes in the way that he's paying his taxes that would actually result in his paying about $500,000 less in taxes over the rest of his life. We showed him how to protect his principal against market loss and how to give himself a raise every year in retirement, increase his retirement income. And when we got done with that, he's going to die at age 100 with $300,000 left in his accounts. So that's what good retirement planning math can do. Take you from running out of money at 84 to still having money when you die at 100 years old. And it's never a bad thing to die with some money left.
Have some left over, a little left in the tank there. Well, friends, have Barry do the math for you. legitimately, legally lower your taxes. And Barry's number at the Wealth Care Corporation of Springfield is 417 200 3500. That's 417 200 3500. Call and leave a message today. Call them at the office during the week and set up your complimentary conference. Barry, on keeping what we have, what are some of the factors out there that could cause us to spend down our savings faster than we expected?
Well, Ralph, I'm guessing that people may perhaps anticipate how I might answer that question, and I'll give you those more stock answers here in a minute, maybe. But I want to focus on some things that I'm pretty sure that you haven't thought of. For example, if you have to pay taxes on Social Security, that probably will cause you to run out of money faster. And the reason is if you're paying taxes on Social Security, that money that's going out in taxes has to be made up in some other way. So that's going to be a bigger withdrawal out of your IRA account. And what we've discovered is that people who pay taxes on Social Security tend to run out of money about 7 years earlier than people who don't pay taxes on Social Security. So that's one of the first things to think about when it comes to considering why you could spend down your money faster than you meant to. The second thing is paying too much for Medicare. If you don't manage your taxes, you could wind up paying 240% more for your Medicare. And why would you want to pay 240% more when you don't have to? If you'll manage your taxes properly, it can reduce the amount you're paying on your Medicare. Now, here's something that seems to be coming up a lot in the culture these days: your children needing help. If you have to wind up helping your adult children out of your retirement money, well, that could deplete the money that you need for later on in retirement. So I just want to give you a little tip there. What I would suggest you do is right now, while your kids don't need any help, I think you ought to sit back and talk with your spouse perhaps about if your children need financial help, how are you going to help them? What is your decision about when you will help and when you won't help? And certainly there are times to help, but there are also times to say, no, you're going to have to take care of this one on your own. And you don't just want your retirement money to be a blank check to kids who, in some cases, might not have lived responsibly and made the best decisions they could. And sometimes that's the best learning opportunity. So those are some things that could impact your savings. And then there's always things like lifespan and how your health is and what kind of health expenses you have and what happens in the stock market and how much you wind up spending, those sorts of things. So there are a number of things that can impact you. But paying taxes on Social Security is one of the leading issues that people don't think about.
Right. So do remember that. So those are some of the outside factors. And overall, the big picture, what's the strategy here, making sure we don't spend it down too fast?
Well, to develop a retirement spending plan, a retirement income plan, I like to use buckets. Ralph, I grew up on the farm milking cows, and so
Sure.
I'm familiar with buckets. And we've got a farm today, and every day my wife and I use buckets to feed the animals. And so I just think of everything in terms of buckets. And I want you to put 3 buckets in front of you now in your mind.
All
And the
right.
first bucket.
Not with feed, but with money.
Yeah, we're going to put money in these buckets.
Money in the
Although
bucket.
feed is money these days, buddy, it's expensive.
Oh, yeah. Here.
But no, we're going to just put dollars in these buckets. And in the first bucket, the one over on the left, I want you to put in that the money that you're going to spend in the next year. Now, how do you know how much money you're going to spend next year? Well, if you know what your sitting on the porch number is, how much income you're going to need every month, and if you know how much you've got coming in from Social Security and pensions, you can subtract what you've got coming in from your sitting on the porch number. You take your sitting on the porch number, multiply it by 12. Now we know how much needs to be in that first bucket on your left. We call that the now bucket because that's the money we're going to need now in the next 12 months. Now, in the center, you've got the second bucket, and I want to call that the soon bucket. That's money that you're going to need to spend, maybe let's say in the next 5 years. So in the first bucket on your left, you've got your now bucket. That's your first 12 months worth of money. If we want to go to 5 years, we'll need 4 additional years worth of money in that. So you take 4 times what's in your now bucket, multiply that number by 4. That's how much needs to be in your soon bucket, the second bucket. So we've got a now bucket on the left, a soon bucket in the middle, and then over on the right, you have a later bucket. And the later bucket is all the rest of your money. That's the money that you'll not be spending within this first 5 years. So you've got a little more freedom to let it grow. You can kind of let it float with the markets and rise up and down a little bit because it'll have time to come back in that 5 years and favor you, hopefully, if things don't go well. And so by dividing up into a now bucket, a soon bucket, and a later bucket, you've got the beginnings of a strategy for how you're going to manage your income over the next years of your retirement.
Awesome. So remember the first and the second and the third bucket. When's a good time, Barry, for us to get a second opinion on these strategies that we plan to use for our retirement income and hanging on to that?
Oh, that's a great question, Ralph. And I would say yesterday was a great time to get a second opinion. But, you didn't do it yesterday? Well, then today is the right time to get a second opinion. So I want to encourage you to embrace that idea of getting a different view on what your money looks like, because you might be surprised at what you'll learn.
We're talking about income analysis with Barry Watts of the Wealth Care Corporation of Springfield. And repeating that number, I'd say put it in your contacts, and you can text Barry anytime. And we'll talk about later in the show some other things you can text to Barry to ask him about. But to text or call, it's 417-200-3500, all around Springfield and the Ozarks, 417-200-3500. Barry, we started the show saying we have nearly half of our households, about 40%, where the head person is between 35 and 64, set to run short of money in retirement. Even these wealthier, the baby boomers, they're not immune to this. We have 13% of the boomers in that highest income quartile projected to run out of money over a 35-year retirement. And we often think of the boomers, they got their wealth from running a dot-com business, and that can come and go just like that. But what's your advice for the baby boomers and the 40% of the households where they're projected to run short of money in retirement?
Well, Ralph, that number is 40% if you believe it. And I'm not sure that I do. I think the number may be higher. Now, you just said that of the baby boomers in the top 25%. So baby boomers are in the top 25% of income. Let me just ask this question of our listeners. Is that you? Are you in the top 25%? And how would you know? Well, according to personalfinancedata.com, if you're in the top 25%, you're making at least $119,000 a year. So you can real easily sort yourself into, I'm in the top 25% or I'm in the bottom 75%. But if you're in that top 25%, making at least $119,000 a year, what you just said, Ralph, from this study was that 13% of those are projected to run out of money during retirement. And that doesn't surprise me. Running out of money is, I'll tell you, the biggest fear of most people who are anticipating retirement. It's figuring out whether they have enough. And I want to say to you, it may not be how much you have saved. It may be instead how you manage your income and whether you pay taxes on your income. Because if you manage carefully and avoid taxes, then you don't have to save quite as much.
All right. Friends, how many times in your lifetime could you make $1 million decision? Could be only once. That's when you make your Social Security claiming decision. This could cost you $1 million if you don't make the right decision, if you decide wrong. So it pays to get it right. And we're going to hear a lot more wisdom from Barry when Watts on Wealth continues right after we come back from this break.
Retirement planning doesn't have to be complicated. Barry Watts can help you simplify it with his kit. In it, you'll find a copy of his retirement income planning booklet, plus information on taxes, Social Security, income, and more. To get your wealth care kit, text KIT to 417-200-3500. That's KIT to 417-200-3500.
Imagine for a moment that an intense storm is pounding your house. Will your roof leak? Will the siding peel away? Will your basement flood? If your house is properly built and maintained, you'll be fine. But what about your 401k or your investments? The stock market has had a pretty good run the last few years, but is its current turmoil making you feel uneasy? Are you confident your portfolio is built to weather a financial storm? Now may be a great time to get a second opinion on your retirement plan. Call Barry Watts and the team at Wealth Care at 417-200-3500 now. They'll examine your portfolio and show you if your investments are in need of some weatherproofing. Call Barry Watts and the team at Wealth Care today at 417-200-3500 to get your no-obligation second opinion. Don't let your retirement get caught in the rain. Call 417-200-3500. Investment advisory services are provided by Wealthcare Asset Management, LLC, an SEC-registered investment advisor. Investing involves risk.
Looking to see what Barry Watts can do for you? Just text VISIT to 417-200-3500. That's 417-200-3500.
Welcome back into the Watts on Wealth radio show, and along with J. Barry Watts, the main retirement designer of Springfield Wealthcare Corporation, I'm your host, Ralph Hipp. According to the Social Security Administration, a retirement benefit of $1,000 is cut by 1/4, 25% to $750, for taking your benefit just 48 months ahead of your 67th birthday. That's when you reach your full retirement age, that FRA, according to the SSA. Now, if you wait even longer till you turn 70, which that's me, I'm about to turn 70 right now. I've already been there and done that with Social Security, and they were great with me. That benefit continues to increase with 8% added to your benefits, that for every year you decide to delay between 67 and 70. So it pays off to wait. And don't mismanage that. When to start taking your Social Security and how and when to decide to do that. Barry, that's the $1 million decision that we were talking about. What are your thoughts on that?
Well, let me walk you through the math to understand why it's $1 million decision. First of all, did you ever dream you were going to be making $1 million decision? You know, we make a lot of decisions every day, but how much you're going to spend on lunch and where you're going to go, it's not $1 million decision. But when it comes to choosing Social Security, you are making $1 million decision, and a wrong choice for some people will cost them in excess of $1 million. So let me walk you through the math. The average monthly Social Security benefit is roughly $1,900 a month. Now, if you do the math, that adds up to around $600,000 over a 30-year retirement. If you're married, you can double that figure. So now we're at more than $1 million in Social Security benefits over 30 years for a married couple. And that's how easy it is for people who are only getting $1,900 per month to suddenly face $1 million decision, and they didn't even know it, weren't prepared for it, and would probably be shocked if they realized how big the decision they're making really is.
Clearly, Barry, you've mentioned this is a pretty big deal to make sure you're taking your Social Security at the appropriate time. And it might seem like the Social Security Administration is the natural place to start. But can the workers there make any recommendations for you?
Well, officially they can't. And so the official answer is when you call Social Security and say, what should I do? They're supposed to say at age 62, your Social Security is this. At full retirement age, it's that. And at age 70, it's this. And that's all the information they're supposed to give you officially. Now, I am told, I haven't been there myself, but I'm told if you go sit down in the Social Security office and ask them, that you'll sometimes get an answer like, well, if I were you, I would take it because it's yours. You might as well take it now. And the problem with that is that's not considering your taxes. It's not considering whether or not you might have to pay some of that money back. There are a lot of factors that you have to think about. And the typical person says, it's your money, you ought to take it now. They're not thinking about the bigger picture.
No. And well, the lady I talked to, she was very nice, but didn't get into the big picture there. But she said, that's money that you're leaving on the table, but that's just me. So we took the money and then we start getting the benefits. What are some of the factors we ought to consider before we start taking our Social Security benefits?
Well, Ralph, I want to say to the lady who said that's money you're leaving on the table if you don't take them, that's just simply not true. It may be money that you're actually adding to your pocket if you delay and take it later. So here are some things to think about. If you're thinking about taking Social Security now, and let's say you're 62, 63, something like that, here's a question to ask yourself. Are you ready to quit working? Because if you take your Social Security and continue working, you're going to lose 50 cents in benefits for every dollar that you earn above $22,320. So I know people who take their Social Security benefit and keep working, and they have to pay back all of their Social Security benefits to the Social Security Administration because they claimed 50 cents of every dollar and they earned so much money that it took all the benefit back away from them. Now, that person has made a critical mistake because they have locked themselves into that lower payment for age 62. But they didn't get the payment. They had to hand it all back to Social Security. So why would you lock yourself into that when you could have let it grow to a higher amount for later on? So the first question is, are you ready to quit working? Second thing you should consider is how much income are you going to need in retirement and where can you get it? Now, some people have got a pension. Some people have got a rent house, or they've got money coming in from some real estate they own, or maybe they own a farm and they've got it cash rented. Or maybe every year when the farmer gets done and brings the crops in, they get a portion of the crop. It's share cropped. Or maybe you come from one of those families from Oklahoma and you've got an oil well in the family. There are just lots of different ways that people get money. But what we need to consider is how much income do you need and where do you have money coming in? And maybe you've got enough money saved up in accounts. You could actually take money out of your accounts and live on that now while you let your Social Security grow. That's not the worst idea in the world. So another thing that you need to ask yourself is, what is your Social Security going to be at the various ages? And what's your spouse is going to look like at the various ages? And what may happen is it may pay to wait in order to provide for your spouse. And that's the situation that Kelly and I are in. Now, I probably will work all the way till 70 anyway, so it really wouldn't matter for me. But my wife was a registered nurse for many years. She worked in the Veterans Administration Hospital. And when our oldest daughter, who will soon turn 28, was born, a few weeks before that, Kelly quit working at the VA, and she's been home ever since. So she hasn't received a paycheck or contributed to Social Security for almost 30 years. And that means that my Social Security check is going to be a lot bigger than Kelly's Social Security check. So think about this. If I take my Social Security early and take a lower amount, well, when I die someday, and I'll probably die before her, Kelly is going to then receive whatever my Social Security is. She'll step up to my amount. So I want my amount to be as high as possible. I don't want to take it early and consign her to the lowest amount of Social Security. So I want to let my Social Security personally grow all the way to age 70. Then I'll start taking it. And then, assuming I die ahead of Kelly, Kelly will then move up and start getting my Social Security amount. Prior to that, she'll get 50% of my amount. And then when I die, her Social Security will go away. She'll start taking mine. My amount will become her amount. And so she'll have the maximum amount possible coming from Social Security. So the point is, there are things that you have to think about, because if you don't think about them, you could wind up doing harm to the person that you love so much. And that would be a dumb thing to do. So don't make a dumb decision. Get your facts.
All right. And to get it all straight for you and your family, to reach out to Barry, like I'd like to talk to you about our situation. And Barry's number is 417-200-3500 in Springfield, 417-200-3500. Barry, let's go over some of the common mistakes, more of that when people make when it comes to taking Social Security. And you've mentioned that taking it too early is that the biggest mistake we make?
Well, there are a lot of people who make that mistake. You know, my own dad comes to mind there. Dad's dad died at 65 back in the 70s. And so Dad took Social Security at the first opportunity he could when he was 62 years old. Now, my dad will turn 81 here in a month or so. And he said to me a few months ago, or years ago, I guess it was now, he said, if I had known I was going to live this long, I might not have taken my Social Security so early, but I never had any idea I'd live this long. So you need to think rationally about what your lifespan logically is, most likely. And yes, I think many people make the mistake of taking Social Security too early. If you're having to give part of it back, boy, that's a pretty big sign that you took it too early. But there's a second thing, Ralph, that is a common mistake that people make, and that is paying taxes on Social Security. You see, if you earn more than $25,000 single or $32,000 as a married couple, you will pay tax on Social Security. The way they figure that out is Social Security has this big calculation. It's called provisional income. And interestingly enough, the math that they use to figure out if you have to pay taxes on Social Security, they put 50% of your Social Security in that math to figure out whether you're going to have to pay taxes on Social Security. And so it's kind of goofy to me that Social Security counts against Social Security in determining whether you'll pay a tax. But ultimately what happens is people who pay taxes on Social Security wind up running out of money about 7 years earlier on average than people who don't pay taxes on Social Security. So if you can get yourself to the 0% tax bracket, and many people can, and it doesn't mean that you're not making lots of money. You could have $1 million a year in income and still be in the 0% tax bracket if you structured your income properly. If you will do some income structuring work early in retirement or even before you retire, it can cause you to be in a position where you won't pay taxes on nearly as much income in retirement, maybe not on Social Security. And as a result, you might be in the 0% tax bracket. And as taxes continue to increase, being in the 0% bracket is a really great place to be, because 50% increase on zero is still zero.
There you go. Barry, you explained that so well. And once again, friends, Barry's number to reach out to him, talk about your particular situation. If you're reaching retirement age, it's 417-200-3500. Barry, how does this overall Social Security strategy you're talking about fit into the big picture of a retirement income strategy? And more about that.
Well, a retirement income strategy, retiring itself is a big, big puzzle. And then the income strategy piece is a smaller puzzle within the bigger puzzle. And Social Security is just one piece of the puzzle. It's a very important piece. It's foundational, I would say. And you need to see your retirement income as a puzzle to be solved. And you need to avail yourself of the expertise of a Social Security puzzle solver, like we have at the Wealth Care Corporation, advisors who help people think through those particular questions.
Well, going back to what we said earlier, a Social Security retirement benefit of $1,000 is reduced by 25% for taking your benefit just 2 years ahead of your 67th birthday. If you wait till you turn 70, that benefit continues going up by 8% per year every year till you turn 70. So a good reminder about that, Barry.
Well, the thing to remember, Ralph, is simply this. If you choose to receive Social Security benefits early, say at 62, instead of waiting until full retirement age, you're going to have about a 30% reduction in the amount of monthly benefit that you receive from Social Security. So you're giving away a third of your benefits. So the lady who told you, well, you might as well take it, it's yours, you're leaving money on the table. No, by taking it early, you're actually, well, in that case, if you take it early, you're leaving money on the table instead of getting that money by taking it earlier. So the reductions decrease as you move nearer to age 67, and age 67 is what Social Security calls full retirement age. Now, the unfortunate thing is that not many financial advisors are willing to talk about this. A lot of them don't even know the facts that, for example, at full retirement age, you can make as much money as you want at Social Security, and there's no penalty for that. There still may be taxes depending on how much money you are making otherwise, but you won't get penalized on your Social Security. So the thing I want to focus on is if you take it early, that 30% reduction, I think that's a significant amount of money. And I wouldn't want to unknowingly miss out on an amount of money like that and not have thought it through and be sure that I trust the math and that it was the right decision. So there are a lot of variables you need to consider before you start taking Social Security. And we do a retirement income plan analysis that includes Social Security analysis to help people think through that, to sort through their different options for how to claim their Social Security benefits, to learn about how your decisions on Social Security may impact not only your taxes, but your Medicare and impact your spouse's Social Security benefits. And from that, we can then usually pinpoint a precise time for you to start taking Social Security to make sure that you get the most out of it and that you don't miss out on maybe tens of thousands or even hundreds of thousands of dollars in your lifetime. And there's no place that you can get that help from the Social Security Administration. So you've got to get it from somebody who's a specialist in retirement income planning. And that's what we do at the Wealth Care Corporation. We'll do a Social Security analysis for you when you call 417-200-3500 and you ask for a retirement income plan. That retirement income plan is free. And Ralph, when we come back from the break in just a moment, I might talk for a few moments about the fact there is no free lunch. So how is it that a retirement income plan is free? Because I think that's something important for people to understand.
Anything about the word free, hang around, friends, and don't go anywhere. We're back with more of that. Any minute you miss of Watts on Wealth could cost you money. So we'll be back right after this break. A little bit of news to talk more with Barry Watts on Wealth in just a moment here. Don't go away.
We all want the freedom to do the things that make us happy, especially in retirement. To get help planning for a future in retirement, give Barry a call today at 417-200-3500. That's 417-200-3500. More Watts on Wealth coming up.
Hey, we're glad you stuck around for more of Watts on Wealth, and along with J. Barry Watts, the retirement designer for Springfield's Wealth Care Corporation. This is your host, Ralph Hipp. Welcome back for our next half hour here. Next, we talk about the penalty for failing to withdraw the full required minimum distribution from your IRA, that RMD, or missing a deadline is now set at 25% of that unwithdrawn amount. You don't want any steep penalties adding to the increasing taxes that we're probably more than likely going to have to pay to withdraw and spend your own retirement savings. So, Barry, that's where we start this part of the conversation.
Well, we do need to pay close attention to your required minimum distributions. It needs to be a part of your overall income distribution plan. And you can't do that without considering Social Security and when's the right time to take Social Security. So I mentioned before the break, Ralph, that, we were happy to sit down and help people do a retirement income plan, and we didn't charge for that. And you might say, now, come on, Barry, what do you mean you don't charge for that? How can you do that for free? I want to explain that to people. First of all, free doesn't mean there's no value, but it does mean that there's no catch. Now, here's the deal. I know you don't know me. You hear me on the radio, perhaps, and I know that you aren't sure who to trust and or whether you can trust me or someone else. And so we have to have a conversation, get to know one another, whether we can even get to the point to make a decision like that. So at the Wealth Care Corporation, we've just adopted a philosophy that says we're willing to sit down together and have a no obligation, no catch, no strings attached conversation. And we'll talk for however long we need to talk and about your questions and your situation and how you're positioned. And at the final part of the conversation, I'm just going to ask you simply one question. I'm going to say, what would you like to do next? And if you want us to help you, well, then we can do that. And if you don't want us to help you, then you have no obligation. So it's a great way to learn and explore safely. And we have literally hundreds of customers across the Ozarks, clients they are, who have come to us to sit down free and learn and said, okay, I see how this works. And I understand now that you're the guy who can help us with that. And we're happy to do that for any of our listeners. All you've got to do is call 417-200-3500. 417-200-3500 and tell them that you want a retirement income plan. And they'll be glad to schedule you in to visit, probably with me, but certainly with one of our advisors. So, Ralph, you were asking about RMDs, the required minimum distribution. So if you don't have a retirement income plan and you mess up, you make a mistake on your required minimum distribution, let's just go through an example and see how this math suits you. Let's say that your required minimum distribution was going to be $20,000. That's the amount that you're required to take out of your IRA this year. And let's say you forget to do it. You fail to make the distribution for some reason. Well, there's going to be a penalty, and the penalty will be 25% of the distribution. So that's a $5,000 penalty on top of the taxes that are due. Now, depending on your tax bracket, the tax on your amount that you should have taken out could be as much as $8,400. So when you add that to the $5,000 penalty, that means the total amount of the $20,000 that you will now have to pay to the IRS is $13,400. That's 67% in tax and penalty on your withdrawal. So it pays to make those withdrawals and make them correctly. And that's one of the things that we help clients with at the Wealth Care Corporation.
Yeah, maybe around 2/3 of it. Yeah. What do those of us in the pre-retiree category need to know, Barry, about taking these RMDs, these required minimum distributions, out of our retirement accounts?
Well, I think the first question is, when do we have to do it? So here's the rule again. If you were born 1951 through 1959, when you turn age 73 in that year, you should make your first distribution. If you're born in 1960 or after, as I was, we won't have to make distributions until we're 75 years old. So that's when you have to do it. And my advice is that you ought to take the distribution out in the year that you are turning 73 or 75. You actually technically can wait until the next year, but then you have to make 2 distributions in a year and it jumbles up your taxes. Don't do that. When you turn 73 or 75, be sure you make your distribution. Secondly, you should be aware that you can either take your distribution in cash or in kind. Let's just say, for example, here in Springfield, a popular stock to own is O'Reilly Automotive. And let's say that you had an IRA full of O'Reilly Automotive. By the way, that'd probably be a mistake, not because I don't like O'Reilly Automotive. I do. I love it, in fact. But you shouldn't have all one thing in your IRA account. But let's just say you did. And you didn't want to sell your stock. Well, you could actually just instruct the custodian to move enough shares of your stock from your IRA account over to your non-IRA account. And when they move that, that's called an in-kind distribution, and it's taxable to you. Now, you are going to have to pay the tax before the next April 15th. But the point is, you can either make a cash distribution where they give you money, or you can make an in-kind distribution of stock or of securities of some type. Now, beware that when you do make this distribution, it's going to count against Social Security taxation. And so half of that distribution is going to count. And if you're married, you make more than $32,000, then you're going to have to pay taxes on your Social Security. And in 2026, your tax rates are all going to start going up. So I think pre-planning your IRA withdrawal strategy right now is really important. And if your advisor hasn't brought that up, it's probably time to talk with a retirement planner who designs the most efficient, tax retirement strategies. And I have to keep my clients reminded of this. We're doing this work for one of my clients right now. And they called me yesterday and they said, "Hey, Barry, we're on Obamacare and we had to pay more for our Obamacare because of these tax strategies." Yeah, you did. You sure as the world did. And I didn't know they were on Obamacare. But it really doesn't matter, because in 6 months, you're going to be on Medicare and Obamacare goes away. And you're going to be in a 25% higher tax bracket in their case for the rest of your life. So getting that money moved out and the taxes paid on it now while taxes are on sale is really, really important. But sometimes you have to stop and remind people about how to balance these competing interests that sometimes nag at their brain this time of year in particular as they're getting their taxes done.
Yeah, and those competing interests, they kind of pull and tug at each other, and what's the right move to make there? Barry, some people who delay Social Security till age 70 and then they have to start taking money from their retirement savings at 73 to make the RMD could be pushed into a higher tax bracket. And that's what some analysts are calling the tax torpedo. How do you define that tax torpedo and how do we get around it?
Breaking news, breaking news. We have an incoming torpedo, the tax torpedo. Ralph, isn't that the way it works? By the way, everybody yells louder and tries to come up with sexy phrases. The phrase tax torpedo is just a sexy way of saying, hey, pay attention to taxes. Your IRA withdrawals are fully taxable to you as ordinary income. They're not capital gains, which are lower. They're ordinary income, and they can increase your tax rate. Now, IRA withdrawals are going to count against your Social Security and cause it to be taxed. And by the way, this applies to IRA or 401k withdrawals or 403b withdrawals, whatever type of retirement plan you have. IRA withdrawals can cause you to pay more on your Medicare. So the fact that it could cause you to pay more on Medicare, it could cause you to pay more on tax on your Social Security, and it's going to be taxed as ordinary income. Well, all three of those things kind of come together and can blow up on you like a bomb. And that's why we call it the torpedo of taxes. It can blow up on you and really make a mistake.
Okay, sure can. Barry, it sounds like tax torpedo is sort of like those two words, breaking news, that we take alert to that. And what do we do from here? How do taxes impact our retirement over time once we make our moves?
Well, it's really simple, Ralph. Every dollar you pay in tax is a dollar you don't have to live on. It's also a dollar you can't give to your kids as legacy. And if you're going to wind up running out of money, it's a dollar that you have to earn back in order to have enough money to live out your lifespan. So every dollar you give up really matters. In fact, every dollar that you pay in taxes is over $4 that you won't have in your account 30 years from now. So here's a way to think about that. If you paid $10,000 in extra taxes, that's $43,000 reduction in the amount you'll have to spend in 30 years. For $100,000 in taxes, that's $430,000 that you won't have in 30 years. And you say, well, $100,000, most people don't pay that. Oh, maybe they do over many, many years if you'll add up the taxes you pay every year. In fact, if you had your tax returns, that would be a good thing to do, is just to add up how many taxes you've paid in your working lifetime. Oh my goodness. It will set your hair on fire. It'll cause you to pay attention to what's going on in Washington, D.C., and it'll probably cause you to become really irritated and annoyed. So saving taxes, Ralph, really matters. It matters to you. It matters for your future, for completing your retirement, and it matters to your family. Why would you foolishly give money away when you can hold it for your family and not pay it to Uncle Sam?
Or especially right now. Well, we have middle of April, tax season rolls around, and Barry, we file it and forget it. And from that, what do most of us overlook when it comes to taxes and retirement?
Well, I think most people just rarely think about it. Everybody thinks about taxes on April 15th, but people don't think about taxes in retirement and what are the impact of taxes on my retirement. The simple fact is taxes are going higher. It's already done. January the 1st, 2026, taxes are going to go higher. And so we want to manage so that you don't pay taxes on your Social Security and so that you pay the minimum tax on Medicare. And so if we can, that you don't have to pay higher taxes in retirement. In fact, we prefer you pay no taxes in retirement. That's what we call the 0% tax bracket.
And Barry can go over that with you. Barry's number to discuss your tax strategy, hanging on to what you have, is 417-200-3500. Give him a call. Leave a message today or call them at the office during the week, 417-200-3500. It's a call that could save you thousands of dollars. NerdWallet says, have you heard of NerdWallet, Barry? I don't know them, but
yeah, I know NerdWallet. It's one of these online things.
Okay. They say the federal tax rates will stay the same till 2025 because of the Tax Cuts and Jobs Act of 2017. And, we're going to have changes in 2026. But the income thresholds that inform the tax brackets are generally adjusted every year to reflect the rate of inflation we have. So right now, it's not a matter of if, but when our taxes will go up. And Barry, it's coming.
Well, it's definitely going to happen. And, I saw the president a couple of weeks ago on TV giving the State of the Union. And once again, he trotted out the promise that your taxes aren't going to go up unless you're making more than $400,000. And I'm calling BS on that. Ralph, you know what BS stands for. The B stands for Biden, and you can figure out the rest of it. I don't want you to assume that you're not going to be impacted. I'll tell you, we do the math every day for our clients, and we see a lot of middle-class mom and dad clients who are affected by tax increases and who will be profoundly affected. Those people that I told you about whose taxes are going to go up by 25%, they're just middle-class folks who've been working for a living all their life. So you need to do some planning now to get ahead of that and avoid that particular problem.
Well, Barry, as we take a break here, friends, stay with us. Lots of Americans who are afraid they'll never be able to retire appears to be at an all-time high, probably with good reason. But with the right help, especially from Barry, we can show you some ways to make what you've saved last as long as you do it. We'll talk more about that with J. Barry Watts of the Wealthcare Corporation right after this.
Looking to see what Barry Watts can do for you? Just text VISIT to 417-200-3500. That's 417-200-3500.
According to the U.S. debt clock, in the time you hear this commercial, our nation's debt will go up by $1.5 million. That's more than $2 billion a day. Right now, our debt is over $31 trillion and climbing fast. The question is, how do we pay it off? One of the most likely answers is increasing taxes. Now think about your retirement accounts. Do you want to pay taxes on some of that money now when rates are historically low, or later when rates are potentially higher? Whether you should pay taxes now or in retirement depends on a lot of things. Barry Watts and the team at Wealthcare know what to look for. Barry can help you create a plan so your retirement is as tax efficient as possible. Call 417-200-3500 to set up a tax strategy session with Barry Watts and the Wealthcare team. That's 417-200-3500. When taxes go up, will you be ready? Call now, 417-200-3500.
Investment advisory services are provided by Wealthcare Asset Management, LLC, an SEC-registered investment advisor.
Imagine your first day of retirement. What do you see? Let's turn that vision into reality. The first step, get Barry Watts' Wealthcare Kit. In it, you'll get information on some of the biggest challenges you'll face in retirement. Request your healthcare kit now by texting KIT KIT to 417-200-3500. That's KIT to 417-200-3500.
Welcome back in the final segment of this weekend's Watts on Wealth radio show. And this is former KSPR news anchorman Ralph Hipp. I'm thrilled to be back on the air, back on the radio in Springfield with Barry Watts of the Wealthcare Corporation. And by the way, regarding TV, watch for Barry and me on KY3. We're starting real soon in late April. And if you're up late or up early, you'll be able to catch us on the TV show. Barry, I'm excited about that.
I'm excited about that too. Going to be on Sunday mornings, I think at 6:30, starting here in just a few weeks.
And we say, check your local listings for the time and the station, and you can watch us and see what we look like. Barry, there's a startling number of Americans. They're really very concerned. They're practically afraid that they're not going to be able to retire, and that appears to be at an all-time high.
Well, I think people are afraid for good reason. Even fairly wealthy people with several $1 million are concerned about this. And I'm not saying they should necessarily be concerned. I'm just saying that they are as I talk with them. So if you're worried about being able to retire, if you're not sure that you can afford to retire, that means you probably don't have a plan. And the statistics tell us that more than likely you don't have what we call a retirement income plan for your retirement. And you may not even be working with the right type of financial professional who helps develop retirement income strategies. So you spend all those years earning your money and accumulating, but when you get ready to what they call decumulate, which is a fancy way of saying spend, it's important that you have a different kind of professional, one who helps you spend money in retirement and maintain your accounts as healthy as possible while you're spending in retirement. And that's what we do at the Wealthcare Corporation.
How does having a good retirement income strategy that you help us build help us feel more confident about the years ahead?
Well, Ralph, the whole point is being able to pull the trigger on retirement and say, it's going to be okay. I've got the money I need to get me through the rest of my life, and I'll be able to pay all my bills. And if you don't know that for sure, then you kind of can't retire. Or if you do retire, you retire with a sense of fear and trepidation. Well, that's no way to spend your retirement. And some people even start going back to work because they decide, oh, times are hard. I think maybe I shouldn't have quit working when I did. Oh, balderdash. Instead, just get a good plan before you quit work, before you retire. And that's going to involve a retirement income plan that shows you how much money you're going to make every year for the rest of your life, how much you will have to spend. And it all starts with knowing how much money you need to spend each month in retirement. I call that your sitting on the porch number. If you did nothing in retirement but sit on the porch, how much money would you need deposited into your bank every month to pay all the bills, buy the groceries, pay the insurance, pay the neighbor boy to cut the yard? How much money would it take for you to live every month? That's a good place to start with that. And so we use that to begin the process of developing a retirement income plan. And I can tell you, having a retirement income plan myself, it is very confidence inspiring to know what your money is going to look like in retirement. And I've already done that, even though I'm still 9 years plus away from retiring. So I would highly encourage people to get this work done. If you don't have it already done, and most people don't, because most people who are in the financial space don't do this work, but we do at the Wealth Care Corporation, and we'd be happy to help you. All you got to do is call us at 417 200 3500. That's 417 200 3500, and say, I want to get one of those retirement income plans that Barry's been talking about on the radio.
Right. Barry, it's kind of a sad state of affairs when the husband and wife, they're still in fairly good health and they're going to live maybe into their 90s, and they look at each other and the husband goes, I've got to work until I'm 75 or nearly 80. We just can't retire. And for them to come to that realization, you can kind of turn things in their favor, and that's a good thing you do. It's important to realize that even if you've been working with a financial pro like Barry, they might not be the right fit for different stages of life. What do you think about, or that couple who's looking for a financial professional, and what are the stages of life where you can fit in and come up with a strategy for them?
Well, I think the problem isn't the problem. I think the problem is you don't know how to think about the problem. People don't know how to hire the right financial professional, and they don't know who to believe and who is one of those people and who's really not one of those people, because there are so many people out there saying, hey, I'm a financial professional, I'm a retirement professional, I can help you with that. And a lot of them, truthfully, are just insurance salespeople masquerading as financial professionals. An interesting thing happened many years ago. The word financial planner was not registered as a trademark. And so anyone could call themselves a financial planner. Ralph, if you want to be a financial planner, you can be one tomorrow. You just need to paint a sign and hang it out on your door and say, Ralph Hipp, financial planner, here I am. You can do that. So the people who are leading the financial planning movement, which is called the Certified Financial Planner Board of Standards, they failed to trademark that, and that was really a dumb mistake. But it's done, over. They can't fix it. Anybody can use the term. So really, you need to dig in and see what a person's credentials are made up of. What is it that they are qualified to do? And be aware that these days, many people have got a lot of initials that are bogus initials, because they don't want to do the hard work to become a CPA or a CFP, which I've done, or become an enrolled agent, an EA, which I have done. And so as a result, they make up some initials and put them after their name. You say, really, Barry, do people? Yes, really, people do that. Now, the regulators are pretty critical of that when they find them. But there are people who've made up all kinds of initials, or they've even made a business out of selling those initials to somebody else by just inventing a little light version of coursework. You take a simple class online, answer 10 questions, and we're going to make you an ABCD or whatever it is. So look for somebody who's got the right kind of credentials. And what you want to ask specifically is, what do you know about planning for income distribution in retirement? Talk to us about the income distribution phase, because, I've been doing that for 31 years. I'm a tax expert. I am qualified to represent clients before the Internal Revenue Service. In fact, I have CPAs who work for me as a part of our company. Just last night, I interviewed a new guy who may be coming from the biggest company in Springfield in the financial space if he comes to work for us. And he is a CFP, a certified financial planner. And so in 31 years, what happens is you collect these people around you who are also experts. You begin to know where the potholes are, and you know what the mistakes that you can make are, and so you know how to avoid those mistakes. And so one of the things that we do is we always ask people to please prepare first a retirement income plan. Because there should be several things that are paying you, not just one thing. Some of the people who aren't really credentialed at this and just sell annuities, they want to show you that the annuity is the solution to all your paychecks, and that's not true. So don't buy into that concept. Remember, I taught you earlier, you should have a now bucket, a soon bucket, and a later bucket. And those three buckets are really important in the design of your own retirement income plan. So, Ralph, that's kind of how you begin selecting a financial professional and some things that you should consider as you do that.
So take advantage of the offers from Barry Watts to make sure you don't run out of money. This is critical information. And we've said many times, you don't know what you don't know, but Barry can really map that out for you along with the team at the Wealthcare Corporation, and you could boost your retirement savings over time. So wattswealth.com is Barry's website. Make the call at 417-200-3500. That's 200-3500. And Barry, we have a few minutes left in our show for this weekend. Always great to get together with you. Can you close with the story of the $5,000 lady that you were telling me about?
Well, I can, Ralph. There was an Axios Ipsos poll. What in the heck is Axios Ipsos? I don't know. Where do they get these funny names?
Yeah.
Here in the Ozarks, we like Smith and Jones, but Axios and Ipsos, I don't know about that. But that poll said 1 in 5 Americans believe they'll never retire. Imagine that. 20% of the people that you meet every day are facing the future saying, I'm going to have to work the rest of my life. Well, that would be discouraging. No wonder they're grumpy when you're processing you through the checkout line.
Yeah, that old couple we talked about, yeah.
And I think that's true, that many of those people are not going to be able to retire in their lifetime. I also see people's finances every day, and I know that some of them can retire if they'll just make some adjustments. And the first adjustment is you need to adjust the amount of tax you're paying and the way you're paying your taxes. People are afraid of taxes, and it's not something to be afraid of. You do have to pay your taxes. You don't have to be afraid. You can save on taxes by making some strategic decisions, but you've got to be willing to make those decisions, and you have to have a tax advisor who's strategizing on your behalf. And most people don't have a tax advisor. What they've got is a tax compliance person. That's somebody who just fills out the forms. Even if it's a CPA, they just fill out the forms. CPAs, by the way, aren't tax experts. They are tax compliance experts. They're experts at filling out the forms. And so you ask about the $5,000 lady. One of my colleagues in a nearby state was telling me the other day about a lady who came to sit with him, and somehow she got in to see him. She shouldn't have even gotten in the first place, because we always tell people, Ralph, that to activate our strategies, you need at least about $250,000 in your retirement accounts to make them work. But somehow this lady got in to see him with only $5,000. And so there's not going to be anything that he can really do to help her. But he visited with her a minute and he asked her, so she's in her 60s, what's your plan for retirement? And she said, oh, well, I'm going to live off the interest. What's the interest on $5,000? Maybe a couple of $100 a year. My goodness. So there's just a lot that people don't know. And sometimes we have to do some educating and bring the light into their life so they can understand the position they're in and what's possible.
That's right. So remember that. And $250,000 or higher, get with Barry this week. And they can also text visit to you, Barry.
Yes, if you just text visit to the same number, 417-200-3500, one of our staff people will reach back out to them first thing Monday morning and get them on our calendar.
All right. Well, friends, that'll do it for Watts on Wealth for this weekend. We're sure glad you could spend most or all of this hour with us. Barry and I are back again next weekend, same time here on the radio station. Barry, thanks again for your expertise, and hope we have a lot of people call and come visit you this coming week.
Great to visit with you, Ralph, and we'll see you next week on the radio.
This is Ralph Hipp, and join us next Sunday for Watts on Wealth.
Thank you for stopping by Watts on Wealth. If you would like Barry and his team to help you make a plan to get to and through retirement, or would simply like a second opinion on your current plan, give us a call today at 417-200-3500. That's 417-200-3500. And join us again next week for Watts on Wealth.
WealthCare Corporation provides tax strategy, tax compliance, accounting, and insurance services through its affiliate American Tax Strategies, LLC. Investment advisory services are provided by WealthCare Asset Management, LLC, an SEC-registered investment advisor. Investing involves risk, including the potential loss of principal. Past performance never guarantees future results. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for information and entertainment purposes only and should not be used as the basis for personal financial decisions without first consulting a qualified advisor. The information and opinions you've heard are believed reliable but cannot be guaranteed as to accuracy and completeness.